Hi everyone, this is Jason Burak of Wall Street for Main Street, and today John Manfreda and I are joined by a special guest. Our special guest today is economic expert and money manager David McAlvany out of Colorado. How are you doing today, David?
Doing great, Jason. Good to be with you, John.
Thanks. It's good to be with you.
Okay, well, David, I wanted to just dive right in here. The volatility in the markets, just in the last few months, as quantitative easing 2 has, officially expired. Just want to get your opinion on the volatility.
Well, there's a couple of ways of looking at volatility. One is, the fact that we really have very few people from the general public participating in the market anymore. Between 60 and 80%, depending on the day you're looking at it, between 60 and 80% of volume on the New York Stock Exchange is being run by black box trading outfits and computer models that are working off of basic computer algorithms. And you're talking about essentially collecting a few pennies here and a few pennies there, some of it just as basic as a redemption fee from the exchange for holding the position. And they're holding it seconds to minutes. This is not your traditional investment scheme. When you think of the New York Stock Exchange, you think of people doing fundamental analysis, perhaps technical analysis overlaid, and coming to conclusions. What do you want to own? What do you want to make a commitment to with your hard-earned capital? That's not really the market that we have today. And volatility is driven in large part by this sort of phantom operator, and it is today's version of an investment scheme. Just so many CPUs or computer processing units that are just cranking through algorithms and buying and selling and buying and selling. So that adds tremendously to any direction, a market that can go any direction, because you basically have algorithms which will track a given trend and jump on board, whether that's driving prices up or driving prices down. The mind of the market is more of digital code anymore. It's not so much a sophisticated or seasoned investor.
Okay, those are some interesting insights. And I was just wondering that what you got me thinking was that about the digital boxes is that we actually don't have a free market anymore. And I was wondering, do you think in terms of QE3, the inflation-deflation debate, do you think there's going to be a deflation scare before QE3 happens? Because I don't see how QE3 can happen.
Well, the issue with the free market is a pretty important one, and I think this, not to rub any of your listeners the wrong way, but one of the biggest issues that keeps us from having a free market is having a Federal Reserve System. We had the first Bank of the United States and then the second Bank of the United States, both of which were allowed to go away. Their charters were allowed to expire in the 1800s. And Alexander Hamilton started the first one, and then the second was actually snuffed out during the third presidential administration in about 1836. And people didn't like them because they saw them as sources of market manipulation. They saw them as sources where insiders and financiers could gain an advantage in the marketplace above the average guy who might be interested in either owning a commodity or owning a stock or owning a bond. And so that's long been the criticism of a central banking scheme, that it creates really two tiers in the marketplace. And you can see that today, certainly in the wake of 2008, you've got those who have survived and those who have not survived the fallout of the correction in 2008. What we would see is an ongoing bear market. And listen, are there free markets today? I would say that there are managed markets, and they're partially free. The good news is you can't manipulate a market forever. You can influence it over a short period of time, but ultimately you can't determine its direction. We saw that in the 1970s and 80s with precious metals, wherein they'd come out with an announcement to knock down the price, and it was that this given central bank was going to be dishoarding and selling gold into the marketplace. And in the early 70s that had some impact. And people would get scared, and the price would drop off 5, 6, 7, 8, 10, even 20%. And by the mid-70s, people kind of yawned at that announcement. They still tried, to knock down the price using those tactics, and it became less and less of an issue as time went on. You see some market manipulation done by the President's Working Group and financial markets. This is the head of the CFTC, the head of the SEC. If you go through your top wirehouse firms, whether it's Morgan Stanley, Goldman Sachs, J.P. Morgan, there is the Fed window, which gives these big companies access to cheap capital, and they can come in on a highly leveraged basis, prop up the market, buying futures on a number of different exchanges, and they can push up the market or keep it from collapse for a short period of time. Can they do that indefinitely? No, they don't define the market. They don't define ultimate trends. And I think the issue is pretty clear. Free markets are something that go hand in hand with a free country, and I don't know that we have anything but a controlled economy and a controlled market today. You look at the growth and the size of our state apparatus, and it's anything but petite.
Those are some great points, David. And the thinking on Wall Street is just so short term right now that originally when the capital markets are created, at least we were taught this in business schools, is that they're supposed to create productive jobs that Wall Street, and when a company goes public, it's supposed to be there to raise the capital so it can grow and create American jobs, and that was originally Wall Street's function. And now we don't really have as much venture capital angel investor firms as we should, and we have a lot of hedge funds and predatory capitalists out there who just are about maximizing profits in the short term, and that's not investing in productive American jobs.
Well, you're right. When you look at a company like General Electric or some of your car companies, for instance, their most profitable wings have been in finance, not in the manufacture of real things. And that's what we've directed our energies towards, is getting more and more creative with numbers. Is it any wonder that we end up with the Madoffs in the world when, as a country, we prize creativity and a manipulation of statistics and numbers versus just focusing on real stuff? I mean, what made us great as a country was our manufacturing backbone. What created the wealth of this country was not games with numbers. It was real stuff and real people getting real jobs done.
Yeah, that's completely.
Exactly, David. And the Henry Fords, the guys who made the V8 engines and the cars, who did the impossible, and that's what capitalism and free markets and innovation and research. If you look at all the products the U.S. created that the rest of the world has been using for a long time, we created those with free markets basically, and the rest of the world copied them, made them cheaper afterwards.
That's right. Now the innovation, the R&D, a lot of that comes from our models, and certainly there's been huge productivity gains, if you want to put it in that category. Outsourcing some of these things to the developing world, but it's been to the detriment of our own balance sheet. It's been to the detriment of our own middle class, and it's been a mistake, in my opinion.
Yeah, I completely agree. One thing, speaking of the markets, I was wondering is I'm heavily invested in mining stocks right now, and now I'm seeing high revenues, their profit margins are expanding greatly. Do you think the mining mania could end up being like the tech mania or even bigger?
I do think it could be like that, John. I mean, part of the issue is that you've got an imagination on Wall Street that is not engaged in that sector at this point. And what lights a company up in terms of its valuation and the stock price moving to a radical and ultimately unsustainable level is when people begin to create new ways of measuring value that company will deliver in the future. For miners, it's a basic business. You dig a hole in the ground, and it's a dirty business. You dig a hole in the ground, you dump a bunch of stuff outside the hole and sort through it and see if you find anything valuable. I mean, there's nothing really sexy about the business, and only once in a blue moon is it profitable. The rest of the time, miners are just trying to scrape by and survive for the next boom. So boom to bust. The busts are nasty. We've seen lots of them being in this business for a long time. And, as you say, the earnings, the revenues, they're coming into the sweet spot, certainly for many of these companies. The inherent dangers of the companies, they are a part of the general equity picture, and you can, with general stock market volatility, see something that has a legitimate growth story still thrown out on its keister just because it's an equity. And when people go to sell, and certainly when they sell in a panic, they don't really sell with a lot of discrimination. It's everything goes to get liquid.
That's great insights, David. I want to talk about like hedging strategies because with volatility, I worked past in the financial services industry, and one of the major things is volatility. But if someone's just a buy and hold investor now in this type of environment, I think they're if they buy in hope for the next 5 or 7 years, I think they might get killed. As the Fed waits, for the markets to cool off, they're going to increase margin requirements on commodities. So do you think some of the best ways to possibly hedge yourself are to learn for someone to go out there and learn to use options, or do you think that people should keep larger cash reserves, either in maybe currencies outside the U.S. dollar or in maybe some bullion, and then if there's an opportunity like in some of those mining stocks, maybe they cash in on that cash and go and buy more mining shares?
Well, I think one thing there in particular resonates with me, and it's not being over-invested in anything. When you're adequately invested but not over-invested, you've got plenty of liquidity to deploy when and if it's appropriate. If you see market volatility, something drops 10, 15, 20%, and you want to lower your average cost per share, and you've got the liquidity to do it, then that's the luxury afforded to you by having thought ahead and having had a large enough cash cushion. On the other hand, if you're fully invested, that's where you're forced to play the patience game. And that's just not really a successful strategy for investing. I think there are ways that you can take a longer-term view and not necessarily trade in and out of the market, but that is predicated on having enough cash available to be able to adjust your positions as time goes on. Certainly if you're looking at outright hedging strategies, cash certainly takes some of the downside volatility and mutes it in terms of total portfolio performance. It also mutes the upside as well. I'm okay with that. If you're looking for hedging strategies, certainly if someone does some research, some homework, and figures out how to utilize options in a hedging strategy, that can be attractive because you're talking about a limited capital commitment. And so, that's the only issue there is that you're bringing in an element that investors just don't have access to, and that's a clear picture on the timing of a given event, a given trend, a given material fact being disclosed. We don't always know what's going to happen next. And the problem with options is that you are limited to a specific time frame. You have to be right within that time frame. Having said that, I like them because it's a limited amount of capital that you're committing to create a limited hedge to an existing portfolio position. But that's something that does take, John and Jason, as you know, some education and some practice.
Oh, okay. That's some good insights for options. One story that really interests me is the release of the U.S. strategic oil reserves. And I personally think that, it was just dumb for many reasons. I was wondering what you thought of it, basically the effects of it will have on the market in the short and the long run, and why do you think they did it?
I think it's blatantly political. It's unnecessary in terms of the market. We've got ample supplies of oil at present. There's no supply constraints. In fact, you've got OPEC who's talked about restricting supplies because there's so much on the market and prices are softening. We've given up 25-30% off the price of oil in a very short period of time. And in that downtrend, it doesn't really make sense to be releasing oil from the U.S. Strategic Oil Reserve. The short-term effect is that it accelerates the downside on the price of oil. I don't think it has any long-term effect. because it compared to world usage, it's a minuscule amount anyways. So I think this is the Obama administration scoring points with a constituency group and wanting to say, listen, we're on your side. We're trying to not only feel your pain but do something about that pain. And coming into the summer driving season, anything we can do to help you, we just want you to know we've got your back. So blatantly political. If this was 2012, maybe the president would have offered to buy everyone a Chevy Volt if they would promise to just vote for me, and then pick up your coupon for your Chevy Volt. Like I said, it's just blatantly political.
Now, David, do you think that this ties in a little bit to a possibly QE3 announcement or its equivalent in the next, month or so? Because Ben Bernanke, in his last few speeches, he is talking about it would be something he would consider, but he needs, commodity prices to go down, especially oil. And, look, oil went down. So do you think that this is part of the plan?
Well, I think QE3 is a tricky one because on the one hand, it seems inevitable. I mean, when you look at gross domestic product today, you're talking about a number that's being propped up through government deficit spending to the tune of 10 to 11%. That's it's a little bit like having somebody on life support and saying they're in great health. Pull the plug and let's see how sustainable this is. If there wasn't government deficit spending today and we took the hit to GDP and we were negative 6, 8, 9%, you know what people would be looking at? They'd be looking at something and they'd be feeling something a lot like the 1930s. That's not the case because government stepped in and replaced the consuming middle class and has propped up GDP. So the guys at Goldman, the guys at Morgan Stanley, the guys at Merrill and B of A, they can all continue the shenanigans about, GDP is going to be 3%, 2%, 1.5%. We're raising our estimates. We're lowering our estimates. It's all a bunch of crap. Pardon my saying it that way, but these guys are playing games. If you take out government deficit spending, we're already negative, almost double-digit negative. So, this is the game that we continue to play: perception, perception, perception. And the reality is, the government will have to spend. And the CBO has already said this. The Congressional Budget Office has already said we're going to spend $1 trillion a year for at least the next decade of money that we don't have. If that's the case, Jason, John, who's financing it? Who's financing it? We've watched the last 5 TIC reports come out, and the last 5 TIC reports all show reduced interest from central banks buying our Treasury paper. Okay? So if it's not the foreigners who are coming to the party, who's coming to the party? Who's buying our Treasuries? Are they going to conscript U.S. assets, maybe forced purchases in pension plans? I don't know, but they have to have an audience for these Treasuries, and if they can't conscript the assets, then it's a foregone conclusion. Quantitative easing Part 3 is around the corner. I think the real question is, what will justify it in the minds of the general public? If you're going to roll out QE3, it has to be legitimate. It can't appear that you're serving the interests of Wall Street, not in an election year, no way. It can't appear that you're serving the interests of big business, again, not in an election year. That's dangerous. So the Fed has got to thread this needle very carefully, and the only way they can do that is in response to some sort of a crisis. Let's say the Dow tips over 1,000, 1,500 points. Now Ben Bernanke, self-appointed savior of the stock market, is going to say something like, this is clearly necessary. We're going to have to spend a few dollars, and yes, we understand the implications. That's why Congress raised the debt ceiling, because they will. And we're going to have to spend a little bit of money. But what we have in mind is the American dream and what you expect is a living standard. We certainly don't want to see things blow out in terms of social stability. Central planners assume that they can do more in the marketplace than the market can do itself. And the problem is we've eliminated the business cycle through adopting a Keynesian model which basically eliminates the business cycle. It's all forward-thinking and progressive growth. There's no reason for there to be an inhalation and an exhalation, a breathing, a normal transition. If you look at nature, Everything around us says there's got to be change. There's got to be a break. Winter is quiet in anticipation of spring. Winter is death. Spring is new life. There's nothing wrong with that in the context of business. Do you know how many bad business plans I've seen? Do you know how many bad business models I've seen initiated? And guess what? They fail. And it's a good thing that they fail, because what it means is there's plenty of space in the marketplace for successful business operations to move forward. The great problem with Japan and more so the United States is that through this central planning model, Keynesian model, trying to smooth the business cycle, we're creating these giants in industry where the little guy can't even, with an even a better idea, come in and compete. You know, you think that businesses like a GE or a Caterpillar or what have you, they're into free markets and capitalism. Balderdash. The more they get a regulation applied to their industry, the better it is for them. They've got money in the bank to accommodate compliance. And guess what that means? If there's greater compliance and greater regulation, stuff that is very anti-business, it means that nobody can compete with them. That means it essentially, in a central planned economy, if you're an established business, it means you're never going to have competition. It establishes your monopoly power.
This is corporate fascism.
Exactly. So the funny thing is that socialism slips over into corporate fascism, and there's a bunch of socialists out there who are against big business. They don't realize that the policies that they would vote for actually enhance the power of the business elite. I'm a pure-hearted capitalist. It's not that I'm being critical of business. It's just business as it is insulated and protected by government. That I do have a problem with.
Yeah, that's a great point. And well, one thing people forget is a best example of this is GE. You know, they raise taxes. Well, they haven't really raised taxes, but GE, they don't have to pay any taxes, and a lot of these carried over interest. Big business has lobbied them, so you can't write off your business expense your first year. So if you made no money, you have to do it, I think year by year. So it hurts the little guy and the small business owner a lot more. And the big business, they love it because they know they're going to be around for at least another couple of years. So they'll get.
And it benefits the lobbyists, too. David, John and I are here right outside of D.C., so, we're very familiar with the D.C. area, the business-as-usual crowd, lobbying culture, the government bureaucrats, and you honestly would not know that there's a recession going on, well, worse than a recession, a depression going on in most of the country outside of D.C. This area is so insulated that, real estate's going up, new restaurants are coming in, they're building tons of condos, for government employees and lobbyists, etc., to move here, very expensive ones. So you can't tell that, because of the government is just continuing to crowd out the private sector.
It's the last place to run out of money. It's the first place to get their nickel, and it's the last place to run out of your dime. I mean, it really is an interesting business model. They've locked up $2.2 to $2.5 trillion in tax revenues, and yeah, everybody comes to D.C. to get their part of that money. That unfortunately has become the job of our legislators. I wish they were more like the state of Texas. You're in session 140 days a year, and I think they meet every other year. We've got guys who think that they need to be there legislating, creating new laws practically all the time, and they never take a break. So
and they're fundraising constantly, too. And then, like most of their constituents, they really don't care about. They only care about you if you have X amount of dollars to donate to their campaign.
Right. No, it's something that has to change, and I would guess that in the context of the continuing economic and fiscal pressures, it will change. The problem is real change never happens on a voluntary basis. And I'm afraid, you and I, the three of us are of a generation that will get to witness massive change over the next 15 to 20 years, change that we probably can't even imagine, political and economic.
Now to talk about massive change, David, on top of, the volatility and the inflation-deflation debate, that we have in the markets here, we have some other fundamental parts of the world economy that have, just tremendous problems here. We have 7+ billion people on this planet. We're running out of light sweet crude oil. There's a lot of oil for now that is sitting off in tankers being stored, but that supply can be worked off a lot quicker than most people think. Can you just talk a little bit about your opinion about the global population here versus, resource scarcity? And, you're seeing that the global elites here are talking about over 100 trillion creating new credit for developing economies. What is your opinion about all of these things?
Well, inflation and deflation, to go back to sort of the monetarist view, not that I'm a monetarist, but Milton Friedman held that inflation is everywhere and always a monetary phenomenon. And inflation starts as a monetary issue, deflation as well, either an excess supply or a deficiency of the quantity of these monetary units, whether it's dollars or euros or yen or what have you. If there's too many of them, then the whole world gets repriced. Everything that you look at from a can of Coke, which they announced just this week that they're going to be increasing their prices 3 to 5%, Coca-Cola. Starbucks has already announced that they're going to be increasing prices on the basis of milk being more expensive. Are we dealing with a supply and demand scarcity issue? Yes, to some degree we are. But even before that, we're dealing with a money issue, and it's an excess supply issue. And the excess supply monetarily means that everything gets more expensive. Everything gets more expensive. And it's just that real goods and services are being repriced for something that is worth less and less and less. You saw this in Weimar, Germany, just as an extreme case, where an ounce of silver was selling in the billions of marks. Now, what did it mean to be a billionaire? Not quite what it means today if you're pricing that in dollar terms or euro terms. It just meant that your currency was worthless. It meant that your currency was worthless. And that's what's happening to us today. Now let's look at something particularly that has supply and demand dimensions associated with it, where it's not just a function of money and money being destroyed. Wheat. Okay, you've got a number of things in the last 12 months that have impacted the wheat market, whether it's floods, whether it's droughts. I mean, you can go North, South America, you can go to Russia. We've got climatic issues which have impacted the supply of wheat, and that's impacted the price. So our local guy here who makes great crepes, if you're ever in Durango, Michel, he's a Belgian chef, and he makes these amazing crepes. He went from paying $10 a bag for wheat last year, flour. Now he's paying $24. Okay, and that is truly a supply and demand issue. But supply and demand related to a particular sector. Where I would be cautious in looking at the commodities markets and painting with a broad brushstroke in terms of, what would I invest in, commodities in general or specific commodities for specific reasons. You've got different commodities which are more or less elastic in supply. If you take soybeans as an example, let's say soybeans have a great year, in terms of price. Guess what? Next year, somebody is going to not plant corn, and they're going to plant more soybeans because they want to profit from the move in soybeans. And if they can lock in higher prices, they're going to do that. Guess what that ends up creating? An oversupply of soybeans. The price solves itself. So, the demographic issue is definitely a slow burn issue. It's not one that you can, Jason, you mentioned, sort of the buy and hold. That's one, particularly with commodities, you can't really buy and hold, in the soft commodities space because of the inelasticity of the market. If you're predicating that investment on the basis of demographics. Demographics are something that may be long-term supportive, but the real impact is going to be into commodities that are utterly inelastic. Mining is an interesting example because it takes between 7 and 10 years to ramp up. You've got a great mine up in Alaska, the Pebble Beach project, or the Pebble project, not Pebble Beach. I guess that's a golf course. I don't play golf, so I confuse the two. The Pebble project, it's been in play for 7 years, and it may be another 25 before it comes into play because of environmental concerns and all this stuff. So you cannot just flip a switch and say, okay, well, the price of gold is up. Let's just crank out that many more ounces. You can do that with soybeans. You can do that with corn. You can do that with wheat. You can do that with a lot of your softs, but you can't do that with your industrial commodities, and you can't do that with your precious metals. So that's, if I were to focus on commodities, that's where I would focus is on the supply-constrained areas from an investment standpoint.
Oh, all right. That's a great point. And well, I was going to ask you two things because you were talking about supply and focus on hard and soft. One thing is, what do you think of potash? Because I consider, I don't know if I would classify food as a soft. And the other is there's a Alberta Oil huge pipeline. Canada wants to construct it with Texas, but the environmentalists say the tar sands are very pollutant, and Canada says if you keep stalling that, they might do deals with China. What do you think is going to end up happening with that?
Well, I mean, Canada's obviously a natural resource giant, and we are their largest trade partner. To the degree that they increase business with China, it's worrying on the one hand, but on the other, they've got a long way to go before trade with China matches what they trade with us in terms of imports and exports. So whether it's lumber or oil or natural gas, we're their primary. And that's they will always be, I think, respectful of us as the group that butters their bread. That's not to say that we won't do some stupid things, and that to some degree prioritizing environmental issues over energy independence creates all kinds of havoc, not the least of which are further environmental issues. I mean, it was just a few years ago that the environmentalists were praising alternative fuels and ecstatic about ethanol and thought that was the greatest thing to supplement fuel. Little did they know that they were in their terms, some of the anthropomorphize, but slaughtering Brazilian forests to plant more corn because of the artificially inflated prices in the corn market. And yet, well, didn't they want corn to be a part of the solution for alternative fuels? So, I mean, this is the problem, is there's unintended consequences. On the surface, I think you and I, all of us, would look around. If you've traveled to a national park, you say, this is an amazing country. This is an amazing country with vast grandeur and beauty, and it should be preserved. And I think we can all agree that that's the case. On the other hand, there's unintended consequences to certain environmental policies, which ultimately can put us in a very awkward position, whether that's geopolitically or, as we just mentioned, environmentally, where the Greens got exactly what they wanted. They just didn't realize that what that entailed was a slash and burn in Brazil.
Yeah, that's exactly what I think too, David. I think, the environmentalists, a lot of them are, let's be honest here, they're hypocrites. A lot of these environmentalists care more about, plants and animals than they do about human beings. And, when you want corn ethanol, at an increased production rate, you're taking away that much, food out of people's mouths. You're driving up the corn price. And I think over 30% of the corn crop this year is going towards corn ethanol. And, corn ethanol isn't even that good. The energy return on energy invested is horrible.
Right. No, so you end up creating the same kinds of civil unrest and discontent in Mexico, our southern neighbor, as we've had in North Africa and the Middle East. They are corn dependent just south of us, whereas in the Middle East and North Africa, it's wheat dependent. In Asia, it's rice dependent. You do something stupid with any of those commodities, and you're going to hear about it from people on the street. And I call it the tortilla revolution, call it whatever revolution, but we are talking about real people with real lives. And this is if you're in the D.C. area, you're close enough to New York to have rubbed shoulders with a few champagne socialists, These are the guys or
Oh,
girls
yeah.
who inherit a trust fund and they want to save the world, but that's not going to prevent them from owning the newest Volvo, newest BMW X5. They're clueless when it comes to the world. Absolutely clueless when it comes to the world and the way things work. Maybe both of you guys are trust fund guys. I'm not trying to throw any rocks here. But the issue is we've got people who are making disconnected decisions and wanting to put something very tender-heartedly, in some cases, in motion, which have unintended consequences. And what we're dealing with when you look at our total economic landscape is unintended consequences. It's unintended consequences today. We live in a destabilized world largely because of the unintended consequences of central planning via the Fed and via our politicians.
Right. Yeah, that's completely right. And yeah, we have in D.C. There's a lot of intellectual champagne socialists. I've had my fair share of arguments, and I was wondering. Right now, China's central planning, it's done really well for a while, but now it looks like there's a real estate bubble. I've recently read there's electricity rationing now for the summer, and I was wondering, do you think the bursting of this property bubble combined with all the electricity rationing, could there be civil unrest in China? And do you think the property bubble is going to burst?
Well, first on the civil unrest side, every year China deals with 70,000 different incidences of civil unrest. So it's not a future tense issue. But whether it's two people gathering and carrying a picket and then them being carried off because you can't officially protest in those ways, or a larger gathering where it's rocks or Molotov cocktails being thrown, it's happening right now. And part of that is just, the nature of China. And I say the nature of China because for 3,000 years, they've always had a demographic problem. Too many people and limited resources. Jason, kind of what you're talking about just on a micro level, specific to their country. Too many people, limited resources, and they've always been fixated with social control, never really taken an outside look at dominating the world because they've got too many homegrown problems to begin with. The real estate issue is a fascinating one. By the way, why do they have such a large military? Well, following the one-child policy for the number of years that they have, they've got too many men. Self-reflect here with me for just a moment, but when you were 18, did you have a little too much testosterone and not enough insight as to how to direct it? I mean, this is
yes.
When you're 18 to 21, this is when you consider yourself to be a superhero. Maybe you're a freshman or a sophomore in college, and you think you know everything. You certainly can't be damaged. You can drive your car 120 miles an hour and take corners.
Yeah.
This is life, right? Well, that's life in China, and that's why they have a million-man army, because the only way to keep from that being a revolutionary force is to tell them to go dig a ditch and then refill it, dig a ditch and refill it, dig a ditch and refill it, and then march for 10 miles. Once they're completely worn out, they're no longer a threat. So from a military standpoint, they're already practicing and have been for decades, crowd control. Crowd control in the form of keep these guys busy or you're going to have a problem on your hands. On the real estate side, you've got roughly 30 billion square feet that's being built at present. 30 billion square feet. Now, I understand they've got a lot of people in the countryside, and there is a mass migration from the countryside to the cities. There's not that many new jobs being created to accommodate the influx of people. Most of the real estate projects that are still in motion today are upper scale condominiums. It feels a lot like sort of U.S. real estate market circa 2006, 2007. The plug hadn't been pulled on anything, but you really were stretching. You've got the state-owned enterprises, roughly 17 state-owned enterprises, which are according to the Chinese audit, they've got their own internal audit group. I forget what they call them. 17 state-owned enterprises. Their numbers don't match up. They're looking at the books and they're saying, they've looked a little bit cooked. We can't make sense of this. Where's the money going? Massive fraud into the hundreds of billions. You're seeing that money show up in terms of flight capital in other parts of the world. You're seeing it in terms of a Vancouver real estate boom. You're seeing it in terms of a Sydney real estate boom. If the Chinese can get there, if they can take their money with them, they're moving out. You can't officially take money out of the country. They've got capital controls which restrict the flow of capital out of the country. So anyone with money has put it into real estate. The problem is they've already done that. Anyone with money has already done that. They've put their money into real estate. They've put some of their money into gold. And now with the excess money, what do with it? They'd like to get it out of China. I think they realize the game is shortly up. And I would expect to see a collapse in China, not only in terms of the real estate market, but the banking centers as well. Your banks are nasty. You know, this comes back to where we started our conversation today. There's a command economy. These are not free market run banks where people are driving profit margins and having to care about how many, you know, sheets of toilet paper their employees are using. Nope, they could care less. This is a part of the state apparatus. This is how they direct cash flow. It's a completely obtuse way to do it. But apparently they didn't learn from Russia that making all left shoes ultimately is inefficient.
Yeah, I was going to say that's an excellent point. That's why I got out of all my base metals, because when that property bubble bursts, you know, it's going to be nasty.
Well, and that ties in to the equation. What do you do with liquidity that's not invested, whether it's in metals or real estate here or the equity markets or however your listeners may have their assets allocated? What do you do with your liquidity? You know, out of the dollar frying pan and into the foreign currency fire. There's very few places that you can go that don't have, because of their commodity trade. On the one hand, it's great. You've got countries that have strong balance sheets and cash flow today, and you know, you look at an Australia and you say, well, gosh, I'd rather own the Australian dollar than the U.S. dollar, except that 25% of their GDP comes from China. So a hiccup in China is a catastrophe in Australia. You can watch the Australian dollar lose 30 or 40% if we're watching at the same time the stock market in China crater to 30, 40, 50%. So the world is interconnected, and big money is asking one question: where do I go and hide? That's all they want to know. Where can I go and hide? Which to me makes the precious metals probably the most interesting play, not from a growth standpoint, but just from a where can I go and hide standpoint.
So from an insurance wealth preservation standpoint then?
Exactly.
Okay, David, I want to wrap up the interview here. I have one final question first, though. You know, we talked about a lot of the problems going on, but what type of solutions do you think the market needs to be allowed to implement to create jobs again here in the U.S.? Because, I mean, if you just graduated college here in the U.S., you know, most likely you graduated, you're graduating with a ton of debt. If you're from around the D.C. area and you come back here to work, your job prospects are pretty much around a $40,000 a year government, you know, bureaucratic job, and that's about all you can find. You know, the jobs in the private sector, a lot of them are no guaranteed salary. You know, you can't even get rent. You know, it's all basically you sell for them and you generate X amount of sales or you don't eat. So what type of things do you think are going to have to be implemented first so we can get back to, you know, the U.S. generating jobs again in the right way and, you know, productive GDP and stuff?
Well, I mean, your biggest obstacle to change is the people who are supposed to be implementing it, and that's 530-odd people back in Washington, you know, who are self-serving and feeding at the government trough. I don't know how you change it outside of changing who's filling those positions. When you look at the House, when you look at the Senate, when you look at who's in office as president, and I'm not talking about just this administration, but the last as well, not seeing the kind of leadership that can take us through a crisis. You know, when you look at a company that is in the throes of failure and being pressed by creditors and watching a decline in sales, you need a leadership in that company that is very decisive, very clear-minded, not concerned about a popularity contest, and is willing to dig in, roll up their sleeves, and if necessary, get as much dirt under the fingernails as they have to solve the problem. It means a tremendous amount of sacrifice on the part of government. It means a tremendous amount of sacrifice on our part as individuals. It takes a different mindset to work through a crisis, and I don't know that we have that mindset in play today. The crisis mindset is actually something that emerges through pain. I don't think you're born with it, but you can find it. I mean, if you look at the greatest generation, what they call the greatest generation, those who existed, now kind of dying out, but existed through the world wars. Were they born with courage? Were they born with tenacity? Were they born with sagacity? No. But they developed it in the furnace of affliction. They developed it in some very difficult times, and it marked them for generations to come. Now we've just forgotten those lessons. So, there is no policy change. There is no policy change because, policies in Washington, I mean, if you go back to the Vietnam War era, how many times did we fight, take back a hill in Vietnam only to give it up to the enemy the next day, and fight and take it back and give it up the next day? When I look at the 2-year and 4-year cycle, it kind of feels like that sort of a charade. Who's in control of the hill? My question is, who cares? Who cares? I mean, this just doesn't even matter. The real change that needs to occur in this country is going to be under completely different leadership. It'll be under completely different leadership. And I don't know if that's in your generation, if that's in my generation, if that's in a future generation. I've got a 5-year-old son, and I don't know if that's going to be in his generation. But where on the basis of serious reflection, there's serious decisions made and serious sacrifice made. We are so self-centered as a people, so self-centered as a people. And until that's gone, I don't think there is a fix. That's the problem with politicians. What are they doing? They're taking care of themselves. What are bankers doing? Taking care of themselves. What is anyone doing today? Do they have the state of our union in mind? No.
Yeah, and I think part of that selfishness too is the short-sightedness too. People, politicians are only thinking about, at most the next election cycle. They're not thinking about, making the country, a better place where there's more job creation and higher real GDP and, less inflation and stuff. You're just not seeing, the people that were making the decisions that were involved in Congress and our legislature back then. Now both parties are basically the same. They just disagree on where to spend the taxpayer loot. They're all, each part of the welfare warfare state.
If you had two choices of either raising taxes or cutting spending, I'm not sure I'd have confidence in either one. I would be proponents for some combination of both, but we've got leadership in place that's going to end up making the same boneheaded decisions in terms of distribution of that limited capital to begin with. So, what good does it do to raise taxes if it's just going to be misspent yet again? That's why I say, whatever may be a pragmatic solution immediately, we've got to dig a little deeper and find a different set of leaders altogether. I think it's going to emerge on the folks who are 50 and 60 years old that they've actually put it to the screws. They're their kids and grandkids. I spent 2.5 hours with Lawrence Kotlikoff in Boston this weekend, and he's an economist at BU, and it was fascinating because he puts it in those terms. He says, listen, basically my generation has robbed and destroyed the next 2 or 3 generations. We've absolutely destroyed them. Yep, it's going to take an ownership like that at the level of leadership to say we made mistakes, we're owning them, and now here are the changes that we're going to put into place, and it's going to mean a tremendous amount of sacrifice, including our reputations, because we were wrong.
And on top of that, David, the corporate media, a lot of the mainstream media, and then even in schools, the textbooks and the professors, a lot of the material people are being taught, is not the stuff that works in real life anymore. And, we touched on this earlier, but, if people knew Austrian school economics, or at least, had been taught somewhat of it in school, they would have a better idea of what's going on. But, this is going to require such a monumental, fundamental paradigm shift that, there's going to be so much more pain before any of this changes that we think need to occur.
The great thing is we've got a huge middle class across this country, and in that middle class are the entrepreneurs, the merchants who have made this a great country. They may be getting squeezed today, but they've got creativity. They've got the willingness to take risk. And when they realize that the system is broken and government's not going to bail them out beyond the 99th week, and if they do, it doesn't really matter, the system remains broken, when they get mobilized, you'll see some changes in the country. You'll see some radical changes politically. And I think they'll be largely good.
And also thanks to the internet too, David. Without the internet, without people freely communicating, I can talk to friends and college students I met in China, and ask them what's going on in the ground. It's just amazing what the internet has done.
Stay aware of the fairness doctrine. The fairness doctrine could change the use of the internet as it's attempted to change the use of
talk radio.
Talk radio. And this is the reality. If we're watching the slow expiration or death of Western socialism, you're going to see a fight. You're going to see a fight like you've never seen before. I mean, you take something as docile and calm as a rabbit, put him into a corner where he feels threatened, that little rabbit will draw more blood than you can imagine. And now just imagine the socialist animal that we're talking about. There's a lot of fight left in terms of this central planning construct. And not going to roll over easy, even if they don't have any money to fund the project.
Yeah, that's absolutely right. So I just want to thank you for your time with us, and I just want to know, for our listeners and everything, if they want to, if they're interested in having you manage their money, or they want to find your podcast or your work, where can they go to find that?
Well, two things. One, if you go to McAlvany.com, that's our last name, McAlvany.com. We do a 30-minute podcast every Wednesday, which is made available to our clients and listeners. That would be a helpful educational resource. Additionally, once a year we put out a DVD. Jason and John, I'm not sure if you've seen that before, but we just finished this year's DVD. And I'm pretty excited about it.
No, we haven't.
Okay, well, if clients want or listeners want to get a copy of that, we'll send it to them for free if they go to orderdvdnow.com. So online, if you want to order it at orderdvdnow.com, you can either download it or you'll be able to download it next week. Right now, you can just submit your request, and as soon as we get the hard copies in, we'll mail those out to you.
Yeah, David, and I just want to personally, thank you for all the hard work you do. And you don't have to, do a podcast every week for 40 minutes or so and share your thoughts with people, because your clients, pay for that expertise. And, I just want to personally thank you for, trying to help and make the world a better place and trying to help get people through this, because this is basically what John and I are also trying to do with our podcast here and, with our company and our website at Wall Street for Main Street.
Well, great. You guys keep up the good work.
Thank you. You too, man.